Right, good morning. On the improve this morning, it's not even 7 a.m. here in wet, blustery, yucky Auckland. How to improve our financial position and all the things that sit on that. So you'll see that that's sitting on the screen already. You should be familiar with that spreadsheet, working through it and having prepared it and doing it monthly. We're going to dive into it and have a little look at different ways that you can improve your finances, because once you have things set in place, then you want to try and find areas where you can just squeeze a little bit extra out and do things a little bit better. So we can use the financial position as a way to start and go through each line item and figure out, right, what could we be doing better, or what things do we need to do some learning around. So let's jump into that. And I've made this a little bigger on the screen, so hopefully you can see it. But basically, you would have listed out all of your assets and your liabilities. But if we take the template and just work through each of the things that are on there, which are the most common things that people have or will have in terms of their assets and their liabilities throughout their life. So I'll make it a bit bigger so that I can look at it better. So if we start with home, well, obviously, if you've got a home, then you want to be looking at the rate that you're paying on your mortgage, and other properties, same thing. So this is where you probably want to speak to a mortgage advisor and find out, right, am I doing this the best way? Do I have the right structure in place? Do I need to be thinking about a trust, for instance, for legacy protection and things like that? But just starting with basic, are you on the best rate that you can be right now? Is there any worth looking at changing between fixed and floating rates and things like that? So getting somebody that has an expert opinion in that space. If you can save yourself a little bit of interest, then you could potentially decrease your a very long time. So worth looking into and keeping front of mind. And I think a lot of people just take the bank's advice and then end up paying a loan over 30 years and don't figure out things like additional repayments that, say they've paid down a car loan, then they could use that money to then start paying down their home loan faster as well. So being a little bit smarter about how quickly can you get your debt down, and then therefore pay less interest and pay less out of your own pocket over time loan repayment. So I've added in the crypto line here, which wasn't in the original spreadsheet if people have downloaded it. That is just because I think it's something that people are starting to invest in and pour some money into, so I wanted to put that there. I don't have a huge knowledge in crypto, but my suggestion would be that you make sure that it's safe and you make sure that you've got it well documented somewhere so that you can access it in the future, or if something to you that somebody else could, if you've got serious dough in there. So I won't pretend that I'm in that space, but there's some basic points there. A car asset. Now, it's not too much that you can do in terms of keeping the value of your car high. Usually they depreciate pretty bloody quickly, but we'll touch on the car loan as we get further down the page. But you probably just want to make sure that you are looking after your vehicle, keeping it well serviced and keeping records of it, so that when you do go to sell it, you're going to be able to maximize the value that you can recover when you go to sell your vehicle. So some other people might have some tips around keeping values of cars up, and we'll chuck those into the comments if they are there. But if we get down to cash and term deposits, so that's what you want to be thinking about, the rate that you're receiving on that cash at the moment. Obviously, savings rates are very, very low. They're probably going to stay there for a while. We're at the top of a debt cycle worldwide, so I can't see savings rates improving. So you need to factor that in when you're thinking about having excess levels of cash where they're sitting. They're actually probably going backwards in the bank at the moment in terms of rates being so low, then the tax you're paying on the savings rate, and then inflation bringing value of your dollar backwards. So if you don't understand that, there is a money mail around that earlier on around saving. So you need to be thinking, where have I got my money sitting, and is it doing any work for me? And if it's not right now, well, is it on my plan to improve that? And am I thinking about how I can get it working for me? Because right now, the only people that are winning from having money sitting in a bank is the bank. So get some thinking wrapped around what you're doing with your excess cash. If you've got a home loan, for instance, and you might want to look at helping decrease the interest you're paying on that by offsetting some of that debt. Again, speak to a mortgage advisor around that. So if we look at shares in public companies, if you're buying these through a broking agency, maybe think about how often you're doing that and at what levels, so that you're not paying fees all the time and eroding some of your gains. So when you're buying and when you're selling, you're paying a fee to get in and out of the market, and you need your share price to increase or a dividend to come in to be able to cover the fees that you're paying to buy and sell those shares. So if you're buying $500 at a time and you're not using something like Sharesies, then just be aware that you probably are paying, $30 to $60 each transaction. And basically, if you buy and sell for $30 at a time, that's $60. So you need at least a 10% gain on your 500 just to get your $60 back. So think about that, be smart about it. Obviously, a lot of people are using Sharesies. So my simple overarching thought process for Sharesies would be, yeah, cool, you're probably going to pay a low fee, a percentage of the purchase each time. And I can't even spell Sharesies correctly in there. So you want to maybe just think about how often you are buying and whether you combine it. Does that affect the rate that you're paying? Also with Sharesies, do you have that documented somewhere for people that, might need that information if you were to die? I know that sounds bad, but you got to think practically here. Does somebody know that you've actually got money in a Sharesies account? So have those records somewhere, or just let somebody know. And you should be doing that with all of these things. You should almost make a list of these things and provide it to somebody. It doesn't need to necessarily show them the amounts that you have, but to say, hey, look, if something was to happen to me and I couldn't tell you, then know that, hey, you might get bloody kidnapped or something, who knows, that you've got each of these things so that someone can help you work through them or help your family work through them if you were to unfortunately pass away, that sort of thing. But that is life, that is inevitable, and that is something that we hide from in New Zealand too. We don't like planning for our future and planning for the inevitable. So we've got very low rates of having a will in place, and that's something we'll touch on in another lesson of Money Mail. So household personal goods, you want to add your value in there. I don't, because I just think that they're worthless because people don't buy them off people anymore. They just go and grab them for free, or they go and get them from marketplace on Facebook and things like that for such low values. But some people include those because they have diamond rings and things like that. So you want to make sure that you've got ways to keep the value of those intact and a record of them perhaps. So Kiwisaver, same thing. This is where a lot of people are getting crushed and their returns are getting slammed. They don't even know it. They're paying high fees to the Kiwisaver provider, and that is eroding their gain that they get long term. So two things for Kiwisaver you should always know is what fund you're in and what fees you're paying to your provider. And that's two things that most people probably can't even answer that have Kiwisaver. A lot of people went straight into default, and there is nothing wrong with that, but that is very, very entry level. You need from there, you need to graduate to, okay, where is my fund actually being held? What's it being invested in? And what sort of fees am I paying on this fund with this provider? So that's why things like Simplicity have become very popular, because they basically just targeted everybody and said, right, we're going to offer the cheapest rates for Kiwisaver, and that's meant that people have paid less for their Kiwisaver to be looked after, and therefore have kept more in their pocket or their retirement pocket. So you want to keep an eye on what you are paying each year. It might not seem much at the moment. If you've got a $30,000 Kiwisaver or $20,000, that's the average in New Zealand at the moment, about $20,000. But when that becomes $200,000 and you're starting to see, thousands of dollars go out each year to maintain your Kiwisaver, you're going to wonder, shit, what are they doing for this? And how long have I been letting this happen for? So just be smart and keep an eye on that, because as it grows, it's gonna you're gonna basically hide from it, because you're gonna think, it's too late now. So don't let thousands of dollars end up in somebody else's pocket when it could end up in yours long term. It's probably a ticking time bomb that other people will end up looking at some stage. So I'm not saying that providers are being unfair. I'm just saying that everybody does things differently with everything in the market, not just finances. So some will be more expensive than others, and keep an eye out. And you want to make sure that the provider has you in the fund that best suits your risk appetite. So say you are about to need the money to buy a house, for instance, you're not going to want to be in a fund that's very high risk, that has a chance of going up and down very, very quickly, and you can't rely on that same amount of your Kiwisaver to be able to purchase that property. So keep an eye out for things like this. Other whatever you've got in there, like I've got bond on property, for instance, just so that you keep that front in mind. It is in your assets, but there's not too much you can do about that to protect that. But just don't forget you've got it, so that you claim it when you leave your property. If you're renting, for instance, life insurance, of all your insurances, you should always be keeping an eye on where they're at. And if they're enough cover, because you could potentially be paying less if the cover isn't actually suited to your lifestyle. So you want to get a couple of opinions on your insurances that you are paying for, because they can rack up over time. I believe they're great products, and Kiwis are underinsured, and they give you peace of mind, and also peace of mind to more confidence in other areas of money. So that is why I think paying for insurance is a good idea. It's probably I've not talked about from that angle, but I just got that in there because a lot of people will include their life insurance into their assets, because if they were to pass away, that money, if the life insurance policy is triggered, will pay out to their estate and can be used to service some of the debt and look after their loved ones once they're gone. So reviewing your insurances annually and keeping an eye on them. We've got a great guy within Keep the Change that can help you do that as well. And I on for my advice around that. So if you're stuck, or if you've got no idea about that stuff, put your hand up and say, hey, can someone give me a hand? Because we've got a very good couple of people that can give you a hand in that space. Same with the home and property stuff. You need to be upskilling yourself on this, because if you're not, you're going to be at a disadvantage compared to other people that are doing. Right, let's jump down to the liabilities, and this is where we've sort of talked about mortgages on your home and on your property, further up in assets, but you want to be chasing the best rates for yourself. Not just always chasing the best. You want to mix that with having some certainty around what you are going to pay, but you don't want to be blind to it and just accepting any rate and going, yeah, sure, we'll just sign here, and at least I've got my home now. That's a bullshit approach. You need to be looking after yourself. You need to be looking after how much you're going to be forking out in the long run to have a property or have a second property. And there's opportunity cost of cash. So if you're paying more than you need to be, then you're not doing something with that money in another area of your life, which could be paying it down faster and freeing up yourself in the bank faster than what you otherwise would have. So think about that. Car loans, the same. You're probably paying a higher interest rate on something like a car loan. So you want to find out if that is the best way to be paying off a car. Obviously, it's a ridiculously high car loan that I've chucked in there, but 10% interest on that in a year would be $6,500. So they can rack up very, very quickly, and you've got to put tax back on top of the 6.5. So let's just say it becomes $9,000. That's $9,000 of your income that you're paying on a car loan, which is a lot of money to be going out. So your car might not be that much, but just think about what rate you are paying on a car loan, and is there a better way that you could be doing that? Could you ask for a better rate? Does another bank have a cheaper rate? And shop around a little bit and just see what other people are doing. A lot of people will put you on finance deals these days where you go and buy a vehicle and you get vehicle insurance for that alone. Very, very product. Sometimes those rates can be astronomically high, but you just look at the repayments and think, it's only a couple $100 a month. That's not going to bother me. Turns out you're paying 15 to 19% interest on your car loan. You've just been uneducated and signed for it, and now you're paying for it literally. So just review that as well, because this whole exercise is about areas where you can improve, and that is one that a lot of people can benefit from if they do have a loan for a vehicle. Now, same thing with cars and personal loans. People that are just paying the minimum, it's mortgage advisors, for instance, as we heard from Mikey the other day, talk about where they're not actually getting ahead on repaying their finance cards, and they're actually paying astronomical amounts of interest at 20% and upwards each month. So you want to stay on top of that, and you want to make sure that you're not getting absolutely screwed by some of those interest rates. And a good exercise to go through when you have debt is basically line each piece of debt that you do have. So starting with your smallest to your highest, and usually your smallest amount of debt will have the highest amount of interest getting charged on it. So that means like credit card debt, things like that. Then once you graduate up to a car loan, you might be paying 8%. Then when you go further up to a home loan, you might only be paying 3% or 4% at the moment. So can you knock off the smaller debt and delete the debt, as we call it, and get rid of it, and then the next piece? So that general rule of thumb might not work for everybody, but it's something that everybody should do. Line up their debt from smallest to largest, figure out what interest am I paying on this, and which one should I get rid of first, and put it into a priority list. So finance cards, very important to stay on top of. I would almost suggest once you've paid off your credit cards, just get rid of them. Be done with them. They don't really serve you. They were a great tool for people to have a gateway drug into other banking products, is what I would call it. And you might think, oh, I'm building up a good credit rating by using my credit card, or I'm getting my air points and all that sort of stuff. Cool. You know, that's sweet if you're disciplined with your money, but if you're not, and 99% of us aren't at some stage in our life, so, you know, you will end up paying interest in some way, shape, or form on your credit card at some stage, or with these finance loans. So just about it and think about whether it needs to be part of future financial planning. Could you use a debit card instead? It's also a freeing feeling for people not to have a credit card and therefore not to be in debt to the bank. You know, those sorts of things can have a big difference on how you look at the rest of your money. I'll just add in down here, buy now, pay later. I think those things are, you know, what lay by, I think it's called, as an example. Well, I'm just going to put that there as a suggestion, is that is kind of the modern day credit card gateway drug. So you might think, oh, look, I'm not actually paying any interest and it's a great product to use. Yeah, it is, but it's teaching you that you can have what you want without having to save for it. And that is very much the opposite to what sort of 2 generations were taught to do. They were taught to save for something, build up the money, and then you could go and buy it. In this day and age, we solve everything with debt. So we basically get everything before you have to work for it, or save for it, or pay for it, which when you think about it, seems so, you know, okay, then why don't our employers pay us months in advance and we'll do the work for it later, you know? So it's a pretty weird concept when you actually start to dig into that, and a lot of it is based around the psychology of moving you up the scale from, you know, this is the gateway to other levels of debt and whatnot. So that's just kind of the fashionable thing at the moment. But do these tools, you know, are they serving you well, or have you just fallen into the trap of using them because other people are using them and you think, well, they can be doing that much damage, but actually what damage are they doing to the way you think about money and you think about other areas of your life? So a little bit deep for you there, but something again that we're talking about, and something that might give you a wake up call and go, yeah, I never really thought about it like that. So are you racking those up, and what's that doing for the way you look at your money? Right, back up to finance cards we're talking about. So yeah, just want to keep an eye on what rates you're paying, and can you get those paid off faster in any way, shape, or form. Credit cards, exactly the same thing, and there's a training sitting there around a balance transfer, which you need to be careful of. One is a balance transfer, which moves your debt from one bank to another at 0% and gives you X amount of months to pay off the credit card. I've used it successfully previously in a poor life of mine, and it's a very good way to delete some of your debt. So say you've got a 10 grand credit card with one bank and they're charging you 10%, you can move it to another bank for 0% and you've got 6, 12, 18 months to pay it off. You know, the reason they do this is because the bank wants to get you as a customer. It's a way for them to get you over. It was very, very popular a few years ago where people had high credit cards and they were you know, offering 18 months to repay debt, which was great. You could actually do it. It was achievable. But at the moment, I see some of them are only 6 months. So you could fall into the trap of getting the new credit card with the new bank and not being able to pay off the debt in under 6 months. Then you're going to start paying the default interest rate and be back to where you were. So only use a credit card balance transfer if you can actually pay it off in the time that they're giving you. So again, do your research, do some learning before you go and do that. It is a very good tool to tuck up if you won't see it get loaded too much around the place, because banks don't really want you to do it. But if you Google credit card balance transfer, ASP, ANZ, Westpac, whatever, you'll find out what they're offering, what each of the banks is offering, and you might be able to move from one bank to the other to kill that. So again, pay it off, get rid of it, delete it, bin the card, done with that. It's not part of your life anymore. Right, personal loans, I mean, those are really up to you. If you're borrowing from family and friends and things like that, to keep an eye on what those are, and can you pay them back faster, all those sorts of the same principles that we've already talked about when it comes to your. So there we go. It's most of the assets most people have. Hopefully that is helpful in some way to get you thinking about different things that you might have and ways that you can improve your financial literacy, your learning, and your position in general. So that's part of one of the lessons within the Keep the Change Night School, which is around improving your entire setup when it comes to your assets and your liabilities. So there's plenty to think about in there, and a great framework to do it is to go through each of your assets, each of your liabilities, and figure out, right, how can I improve this? How can I get rid of this? How can I make this better? How can I make this work for me? What don't I know that I need to go and learn about? What do I feel confident about here? What don't I feel confident about? Who should I ask for help? All those sorts of things that we're not necessarily taught to do. Hopefully that's been helpful for you. I can see a few people tuning in, which is good to see. Any questions, comments, drop them in there. Anything you think I've missed, love to hear that as well. Leave your own literacy and your learning around each of your assets and liabilities. Love to hear it. Go well, have a good day.